Hey everyone, it is Evan here from the Trade Risk on Thursday, April 9th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So markets are closed tomorrow for the Good Friday holiday, so we have a holiday shortened week. That's why we're posting this a day early on Thursday to wrap up this week's action, and it was an extremely impressive week of action here for the bulls. All of the major indices finishing up firmly green, to say the least. 10% moves for the Dow and the SPY. The IWM up 15%. The Qs up 8% here. Those are just weekly numbers, setting records or going back, decades in a lot of these indices in terms of the magnitude of this week's gains. It's quite extraordinary. Just 2 weeks ago, we had some kind of record-setting or multi-decades record-setting advances in the major indices, and in most cases we just broke those again with this week's rally. So good move here, continued move by the bulls, continuing to keep this bounce alive. We are above the 10 SMA across all the major indices, and if you look here, the Qs have reclaimed even the 200 period simple moving average. So some signs of stabilization and improvement as a whole is continuing. Now, if we scroll down and take a look at sectors here, we can see everything in the green: materials, financials, utilities, all at the top of the list here, up anywhere from 13 to 18%. So again, just extraordinarily large numbers there. And you'll notice that those three sectors in particular have been some of the most beaten up areas of the market. And I know that does sound strange to hear utilities kind of fitting in that category, but if you recall, it was at the bottom of the list here in our past video. So it was been in the underperforming camp, but now coming back full circle, rebounding aggressively to the upside and leading this week's rally. Now on the downside, we had biotech, we had staples and healthcare. So sort of a more defensive health tone to the market. In a lot of cases, these are the sectors of the market that were kind of holding up, that weren't as beaten up and damaged on a relative basis. So, the trade this week seemed to really be a resurgence in some of the most oversold and beaten up areas in the market. Now, in terms of major markets here, natural gas, top of the list here, 12% move to the upside, followed by the S&P and high yield. So debt, credit market up in the top of the list as well. On the downside, we had volatility, we have oil, and we have TLT. So a little bit of a kind of diverse mix down there, but let's jump into the charts now. And we'll kick things off here with the S&P 500. This is the weekly time frame perspective here. So each bar represents 1 week worth of trading, and we are looking at the cash settled market. So clearly we can see strong advancement this week, up 12% here in the S&P 500. And you'll notice that we also took out the last 2 weeks highs. Frankly, we took out this little 3-week zone kind of right in here. We'll look at this a little bit closer on the daily chart, and we talked about this in our midweek video earlier this week. So around that mid 2500 area, we took that out, and we really just kind of surged and haven't looked back here in the S&P 500, closing quite strong on the week. Now, a couple of things to note. First and foremost here, this is sort of a continuation week. So what we essentially had was 2 weeks ago, we had this outside reversal week that took place. We digested that last week with this pretty much an inside bar, but not quite an inside bar, because I think we technically peaked over last week's highs, but we essentially had this little consolidation period here for a week's worth of trading, and that was it before kind of the cannonball, continued to the upside here. We got that second leg coming out of the week strong with the Monday gap up and go, and that really just kind of set the tone for the rest of the week. Now, if we were to switch over to this board here, this shows just generally I just have fibs drawn from this impulse leg down. So from the highs where we rolled over in February down to the lows about 4 weeks ago, you can see that we have now retraced approximately and closed right at it, about 50% of this down move. So in very short order, and a week like this week up 12% will certainly do it, and we've effectively had two of those back to back, or one week apart, but we are now all the way back to a 50% retracement. And if we say it another way, we've essentially rallied about 27% off of the lows. Let me see if I got that math right. Yeah, approximately 27% off of the lows is the rally that we've seen so far. And if we were to then sort of map out how much further until we get back to all-time highs, it's only about 22% more, which is a lot. I mean, 22% rally from here is certainly a lot. It's no joke, but it goes to show you that, with a 27% move off of the lows, we are now kind of closer to the highs than we would be, kind of rolling back over or thinking about the distance that we've already rallied off of those lows. So it gives you some perspective of where we are. And, again, from a high level, it still does tell us that even though we are seeing these big moves to the upside, we are still, only halfway recovered from all of the carnage from February and March. So again, if we think about just market structure in general, even, the strong trends in either direction, up or down, will certainly retrace half of the legs, impulse legs, followed by retracement legs. 50% of those retracements is kind of a normal area to sort of retrace, even in, again, a strong downtrend. So effectively what I'm saying here is that we're not out of the woods yet. This is a very nice improvement by the bulls. It's very nice to see the stabilization and the conviction kind of coming in here, but it doesn't change this technical picture just yet. So with that, let's start to look at things a little bit closer. Let's go down to our daily chart and let's look at this roadmap. And if you've been following along in the past videos here, I think we've done a pretty good job at sort of navigating the path that the market has taken over the past, call it 3 weeks, since it started to attempt to sort of bottom in here in mid to late March, followed by the reversal, and just kind of covering this action in general. I think we've been pretty on top of it, in terms of what to expect and how to be prepared for this type of market. And our last sort of, big kind of takeaway here was last Friday when we ended here. We talked about the fact that we basically had this tale of two gaps, and we essentially had the stage set coming into this week for some range expansion out of this 3-day tight overlapping range. And we had no idea which way the pendulum would effectively swing coming into this week, but we knew that it would lead to kind of the mood being set for this week, the tone to be set for the week ahead. And we got our answer very quickly because on Monday we gapped up and we just continued to charge higher. We didn't look back. We didn't attempt to fill the gap Monday. We just had a gap up, leaving a little mini island here, if you will, and we just closed strong and took out the prior or this significant kind of resistance area here at 26.35, which was the highs from 2 weeks ago. This was, really the day to take notice and to, either take action. If, again, speaking to the short-term traders here that are trying to trade, navigate, and manage risk in the very short-term, day-to-day, trading sessions. So this was the day to really take notice here. This is when we had our midweek video and we talked about how ugly, this short-term kind of exhaustion signal was here on Tuesday. The fact that we opened up high and strong with a nice gap higher, but then we gave it all back into the close. And the thought process on Tuesday's video was, look, as long as we are above 26.35, the benefit is still to be given to the bulls in this case because we are still in this kind of uptrend above resistance here. And effectively, what we would have needed to see on Tuesday was a gap down and follow through selling by the bears to kind of change trajectory and help us potentially, get off the excitement of Monday's rally. And we did not get that. In fact, we got the exact opposite. We got a complete reversal and a close up at Monday's highs. So once again, we got another kind of more evidence to basically suggest that the bulls are still in control here, and that led to more gains here into the end of the week and closing a very strong week. So that's sort of how we got here and where we stand. And again, the past videos that we've put out, I think we at least covered a pretty good open mind scenario of how these of how this path can unfold, and we got our sort of higher low scenario that we talked about a few weeks ago in this zone, in this chop in here. So where are we now? Where can we look to help us sort of navigate this market? Well, first things first, in the short term, the bulls still have the ball in their court. So the momentum is still here and in the short term, still in and favoring the bull case. And what's happening now is we're at the point now where that FOMO is starting to kick in for everyone that didn't buy in here, or, didn't chase this market, or they're underinvested, or they're hedged, or they're trying to short. They're now looking back and seeing us get further and further away from the lows, and starting to wonder if this is the time where they need to kind of jump in and buy. And my greatest suggestion here is to not fall victim to that, not be in that camp. Again, we talked about it last week's video, but you really don't, and it's so much easier to be said than done. You don't want to be FOMO buying in here without a plan. I'm fine with it if, it makes sense if this is part of your plan. If you were saying all along, look, the market needs to get up to 2,800 and then I'm going to start buying, that's enough proof for me. I'm going to start buying, and I have a strategy and I have discipline. This is part of a predefined plan. That makes total sense. But what you don't want to be is just kind of ad hoc jumping in here and, kind of winging it and very discretionarily trying to navigate high volatile market, because that's going to be a recipe for disaster. So you got to be cautious there. But and quite honestly, I forget the train of thought of why I even brought that up. But I think to backpedal here, bulls still have the short-term momentum in their favor. And when we look at some bigger levels, 2890 above us, I think that's a next big sort of relevant resistance area as I see it. It's basically where we had some emotional trading back on 39310, put in kind of a little bit of a pivot point here. It was essentially where we sold off back in February the 28th. We found buyers step in. We basically had a little bit of a tail here on the 6th of March, and then we had resistance here where the market failed. And I think this 2890 area all the way up to the round 2900 is going to be a pretty interesting spot to pay attention to and to measure the commitment by the bulls. If we get back up there, it's about 3.5% higher from where we're currently trading, and that's the next relevant sort of big resistance area that I would be paying attention to. Now, on the downside, I'd still be watching this 2635. I think this is going to be a key area so far going forward. Again, it just plays an important role in where we found some resistance just 2 weeks ago at this point. It's where the breakout was on Monday, and we had this little kind of two-bar reversal pattern here on Wednesday and Tuesday. So 2635 up to 2640, I would say that is a good level still on the downside. If we start to roll over, if we start to take that out, then I would become more concerned, neutral, or just slightly more pessimistic in this market if we started to roll over and lose that general area. So that's, really kind of how I'm looking at the S&P 500 chart right now. We're kind of in no man's land here as far as I see it in terms of relevant levels. We're kind of right in the middle of, a 2900 to 2635 range. So it really could go either way here in terms of, in terms of near-term volatility. But of course, again, short-term trends are still higher, and we should respect that. Now, a couple of other things to note. First is VIX. Let's take a look at how this finished. So yeah, we can see this is still kind of reluctant to sell off any more aggressively below this low 40s area. So right now it looks like, you know, if we were to do traditional technical analysis here, it looks like a nice bull flag printing in volatility. Again, I don't even want to go down that sort of rabbit hole and debate on whether or not we can be doing TA on the VIX like this. But regardless, you know, we still have a very elevated risk environment here, you know, which is suggested to us by a 42 VIX, which is well above historical sort of averages. So again, caution still advised here for sure. VIX is you know, not just totally giving everything back up and rolling back over into the 20s, you know, suggesting that the worst is behind us. A 42 VIX basically still says the market is worried about something. There's still something out there. We know, you know, really what that something is, but if it starts to flare up, if things start to tip in the other direction, this could easily, you know, start breaking out and lifting back to the upside. Another way you could think about navigating some of the S&P 500 looking for that turning point, if that's what you're looking for, is I think the VIX is sort of relevant here because we really haven't been able to, you know, sustain a close, you know, or put in two closes, two green closes, or breaking this downtrend line, or taking out a prior day's high. I mean, we had a little flare up here on Tuesday, but we quickly gave it right back. So for me, again, you know, if the VIX starts trading back over 47, if it starts taking out some of these recent levels here, and fear starts coming back in the market, you might even get an early turning point sign here versus the S&P 500, you know, using that 2635 zone. So a couple of things to think about, but again, I think, you know, generally speaking here, you really need to know your time frame, because in the short term, bulls still very much in control. We talked about the bigger picture, the fact that we are still only at about a 50% retrace. So again, the worst is not necessarily behind us yet. The market is currently climbing the wall of worry, and we'll see, you know, how far that goes, and just how, you know, how much conviction the bulls have behind them. So all in all, I think that's the story there. More, you know, more stability in the market's a good thing. The trend is still, you know, working itself higher here in the short term. Oh, and actually that was the last piece I wanted to talk about was I'm a fan of measured moves. And if we were to draw, you know, just a quick potential leg one, let's just clear this up. So if we consider last week a sort of leg one move, 2 weeks ago, a potential leg one move, and we did a symmetrical kind of rally here to get us, you know, essentially the same magnitude move that we saw in the first leg higher. That would bring us to approximately 29.29, which would basically, it looks like it would fill this gap over here. So, you know, 29.29, let's see if we were to put this back on this chart here. So it would extend a little bit further than, you know, what we outlined here. So maybe a little bit of an overshoot or in this general zone. Again, I'm not a fan of super precise levels, but again, generally that 2900 zone up here, that again would be a relevant level, and you do have some cause for it with this potential measured move that the market might be kind of embarking on. So something else to sort of keep in mind and kind of help the shorter term traders navigate. So that's it, I think, for the S&P 500. If you look at the Russell, this had, again, we talked about this on the midweek video here. So this was Tuesday when we did the video, and we basically said, look, the Russell is kind of back to its old, you know, underperforming ways here, and the fact that it hadn't been able to take out resistance was a concern, was a problem. But what happened was the very next day, it came roaring right back, 5%, nearly 5% to the upside, closed above this resistance area, and then you can see it continued with a gap up, and kind of continuing into this gap here made back on the 12th of March. So what we have now is the higher low that is in place, and we did just take out resistance. So we are in the process of making a higher high in the very short term, and that again is constructive and certainly what helped move the needle here and move the market into a strong close and into a strong weekly finish was kind of the Russell 2000, and a lot of the names in here are certainly the names that were beaten up the most over the March sell-off. So that was encouraging to see. And the Qs here was a little interesting because we're seeing a little bit of a changing of the guard again. It depends how specific you want to get, but in the very short term, we're starting to see a little more hesitation here in the NASDAQ 100 in technology, in semiconductors too. We'll talk about that later in the video. But basically, these are generally speaking the names that were holding up better than the rest on this move down. So the fact that we're getting a rush to kind of bounce the most oversold things like banks, like energy, then it makes sense that these here, the technology, would take a little bit of a breather. I think that's what we're seeing. But again, we want to just keep an open mind. We always want to be aware of the little the little nuanced moves. And the fact that the Qs here, basically, again, you can see the way they closed the week. They closed the week below the highs here from Tuesday. So they didn't get the same oomph and the same, strong finish to the week like the Dow did, like the SPY did, like the IWM did. You're seeing a little bit more of a sluggish behavior here. So again, structurally, it's still up in the short term. We still have a higher low and a higher high in process here in the very short term, but a little bit of a slowdown is something to be noted. And if we start, again, if that leads to, aggressive selling, if that leads to follow through selling, if that leads to more conviction by the bears here, that's a problem of concern. For now, we'll chalk it up for, some general volatility and some general sector rotation. So that's it. That is the market as a whole. Let's now jump into some of the other major assets in areas of the market. We look at the TLT here was down 1.85% this week. I think that's kind of normal or expected behavior. I mean, especially in equity market, that's up 12%. We'd expect TLT to maybe take a little bit of a breather. And in fact, that's what we've been hopefully, really kind of calling for the past couple of weeks here. So I don't really have any new comments, kind of just, working itself sideways here. And I think rightfully so after all of the move that it's had. Now, GLD had a very strong week, 4% to the upside, and we are now back to its 52-week highs, and we are in the process of now testing and in fact closing at new 52-week highs based on the close here on Thursday, but we are testing this general zone here. So coming in on Monday, it'll be interesting to see how the market reacts to this area. Do we just get immediate follow through, and do we just totally ignore this prior supply up here, or is this some type of bull trap, and we start the week off with a gap down, and we are in fact sort of range bound in this general area. For now, the trends remain up here, so I would say, the bulls still have the benefit of the doubt, but we are back in resistance, so let's pay attention to it. But nice week here for GLD and also for silver. Silver had a 6.5% week. Again, a lot more messy action here in terms of where it is on a relative basis. You can see silver is just coming back into a lot of prior supply in here, so much less attractive to me. Silver looks good in the short term, but there's nothing that jumps out to me here to be wanting to add or buy silver at this point in time. Last but not least is energy. This has still been a very hot spot for the market. It ended the week down 16%. Remember, it was up 32% last week. So we're seeing extreme volatility continue to pour into the energy or into commodities and oil specifically. Seeing extremely high volumes still continue to pour into this market as well. So going out of the week here near its lows, well off of the lows from last week, however. So again, I think if you're a short-term trader, you've got opportunity here. You've got very elevated ranges. This would be a big win if the bulls could step in and support this over 460 and put in some type of higher low over 460, maybe have what would be a very lopsided and certainly not precise kind of inverted pattern here that could play out, but something to keep an open mind about. For now, though, still needs to prove itself. Last but not least is natural gas. Natural gas, talked about the fact that in our midweek video, how it had this three very kind of high conviction looking bars here. It's retracing some of that move. So that move was good for 22% across 3 days. We're now pulling back here. And I think this would be a great spot for natural gas to hold. I like the potential here for this to try and bottom out. It's going to get back over, 1350 or so. But if it can put in a higher low in this general zone and start to collect itself, I think the bulls here could move for a second leg higher, back up and test the lower 15s if we can stabilize here. Got some momentum divergence, so got some potential, but natural gas is a heartbreaker and tends to frustrate the majority more often than not. So careful there. Again, it's experienced traders on natural gas only. Now let's move into some of the sector analysis. I think that wraps up all of our major markets. If we look here at the top performing, worst performing sectors, so best performing sector here is XLB. So this is materials. Again, this kind of shows the beaten up trade. This was one of the most beaten up areas of the market. You can see now with this 20% week it just had, a pretty monster move here, and it is back up to the 51s. Again, from a technical perspective, looking at this on a longer term basis, there's really not a whole lot to like here in materials. I mean, we got a very strong kind of technical oversold bounce, as I would call it, but look how much overhead supply is in here. The trend is just still very firmly kind of lower. So again, short term, it could be a very difficult short, and I'm not necessarily advocating that, but I just think that there's better opportunities here, and there's obviously individual stocks that would look better than just the XLB outright, but on a general basis here, sector basis, this doesn't look all that attractive to me, especially after that move. XLF, kind of the same thing here. This one, really again hit hardest on the way down. It's kind of bouncing in its oversold bounce type of fashion here, but there's a lot of overhead supply. This trend is pretty much broken, and again, I just think there's better opportunities out here. So it doesn't mean it can't still rally another 5-10%, maybe even fill the gap up here around $25, but generally speaking here, just doesn't look all that attractive from a classical kind of technical analysis perspective. Now, third best performer is XLY. This one's a little more attractive, and really the reason is because it doesn't have this wall of supply. It's not in a clear sort of downtrend, like XLF and XLB. It's in fact back over the 2018 lows here. So there's just a lot more to kind of like about XLY to even despite the move that it's had. So again, I'm not saying I would go out and buy it today or tomorrow or Monday, but at least on a relative basis, XLY to me looks a little bit better than those first two, but nonetheless, strong bounce helped lead the market to the upside. Now on the downside, IBB. So IBB here, worst performer on a relative basis, but again, when we look at the big picture here and we just maybe even clean this up a little bit, I actually don't hate IBB because while there is no trend, there's no uptrend to speak of, it didn't really lose any major levels during the sell-off here. So it came essentially to the bottom end of a range, and now it's bouncing back to the upper end of the range. So again, from a relative basis, IBB here, I think it looks actually mildly interesting. Obviously, to get a real trend move and a breakout happening, it needs to get over 123. So it's still some ways away from that, but it at least isn't got a tremendous amount of downtrend pressure and overhead supply. XLP, so XLP here, we've been disclosing pretty much every week here that we do still own this. So our strategy that we trade, which is our Merlin trading strategy, does continue to hold consumer staples here. Again, it's second worst performer this week, and this makes sense because this wasn't an area of the market that got totally clobbered like a lot of the other components in areas of it. In fact, if we were to look at where it's trading right now relative to prior all-time highs, it's only about 10% off of those highs, or I guess if we take the math this way, it needs to rally, about 11% to get back up to all-time highs. So still a little ways to go, but much closer to highs than some of these other parts of the market. Again, from a technical perspective, it's well above the 2018 lows. And, there's not a whole lot of tremendous supply above this either. So we still own it. Again, I don't necessarily think it's a great idea to be chasing this right now, but we still have it. We're looking for higher prices, and hopefully we get those. Last but not least is XLV. Once again here, third worst performer, but on a relative basis, still looks much better than lots of other areas of this market. Could run into some resistance here as it comes into this prior heavy supply area in the mid 90s. So again, tough to chase, but certainly still making progress. So that's it. That is the recap for this short week. Lots of improvement out there in terms of market stabilization and bulls continuing to charge to the upside, but risks are not absolved. There's still plenty of things to be worried about, and time frame certainly matters. So make sure you manage the risk and just sort of understand where you live as a trader and what you're looking to achieve. So that's it for me. Thanks so much. Enjoy the long weekend. Thanks as always for tuning in and watching. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great weekend. We'll see you back here next week.